Hey.
You already know.
On Wall Street today, the Dow Jones Industrial Average was off almost 6 points. The Dow finished the day at 1247.86. Trading was moderately active as some 87 million shares changed hands. Losers outpaced gainers, 580 stocks advanced and 1,250 declined.
How many times have you heard those words on radio or on TV newscasts? Well, you might not have known it, but everything that man said is a stock market technical indicator. We are now ready for the technical side of stock market analysis. In the last segment, you remember, we talked about fundamental analysis. Those are trends outside the stock market. Now we're going to take a look inside the market. Let's take another listen. Luckily, I'm tuned to one of these all-stock radio stations.
On Wall Street today, the Dow Jones Industrial Average was off almost 6 points.
The Dow Jones Industrial Average. That's just a stock average. Stock averages are the best known and the most closely watched of the market's technical factors. You can find them on the financial page of any newspaper. The Dow Jones Industrial is certainly the most famous. It is made up of 30 of the nation's most important companies. The Dow Jones Company adds up the prices of all those stocks, averages them out, and today it came out to, as the man said, 1,247.86. The kid has an incredible memory. Dow Jones also compiles a separate transportation average of 20 transportation companies, a utility average of 15 power companies, and one called the 65 stocks, which is all three indexes combined. The big stock exchanges each compile averages of their own. There's the New York Stock Exchange Composite and the American Stock Exchange Composite Index. These average almost all the stocks on the exchange, and they give you a pretty good sense of how the market is moving. There's also one for over-the-counter stocks. It is called the NASDAQ Composite. Check out these averages every day because you will get an idea of how the whole stock market's been doing.
Trading was moderately active as some 87 million shares changed hands.
Okay, 87 million shares changed hands. That's our second technical indicator, volume. Volume is the total number of all shares of stock traded in one day on each exchange. It's one of the most revealing indicators of the condition of the market. But first, you've got to know how to use the numbers. So let us say that this balloon represents the volume of trading on a Monday on Wall Street. Now, for the sake of argument, we will say that this is 70 million shares traded, which is a moderate day, which is very nice. But what does it tell you? By itself, this single statistic tells you, frankly, almost nothing. But let's compare it with the next day, Tuesday, on which 85 million shares were traded, and then the following day, Wednesday, a big day, 105 million shares traded. Now, look at all 3 days of volume, and now you begin to get someplace. We are looking at building momentum of some kind, the beginning of a trend of some kind, because every day this week, some shares have been traded, then more, and then even more. But what kind of trend is this? Well, volume alone just doesn't tell you. You've got to go back and see what happened to stock prices on these days. If you look at this rise in volume, and you know that on this day prices also went up here, and then more on Tuesday, and even more on Wednesday, now you know you've got a major upswing. People are pouring money into the market, and you would be very safe in predicting that on Thursday and Friday, later on, prices should continue up. But suppose if on each of these days, instead of going up, you discover that prices are going down. That means you got some selling on Monday, more selling on Tuesday, and a lot more selling on Wednesday. Now, this tells you something quite different. People are getting out of the market, and they're getting out in a hurry. Things are getting worse every day. This indicates that later on in the week, you could get more decline, maybe even a bear market. Either way, when you combine volume and price, you can use them together as a guide to where the market is headed. Let's do one more round of this just so you get the hang of it. This is going to be, this time, a low-volume week. On Monday, 73 million shares traded. 80 million shares on Tuesday, a little bit better, but not really much of a difference. And on Wednesday, 74 million shares traded. I'm going to add one other fact to this week of volume, then I'm going to ask you a question. I tell you that prices rose just a little bit each of these days. Now, what does this tell you about the direction of the market? The right answer is to ask yet another question. You should be asking, well, what's been happening in the previous months? If prices have been rising steadily, then this could just be a pause after a big, nice, fat buying spree. Or it could be the beginning of the end, the beginning of the decline. Or let's say prices have been falling up until this plateau. Then this could be good news, the end of a bad time. Remember, you don't want to look at volume by itself. It doesn't mean much unless you look at stock prices and at recent trends in the market. That is how to use volume to interpret the market. There is one other aspect of volume that you should keep your eye on, the volume of block trading. Now, banks and pension funds and insurance companies, even rich people, trade in big blocks of stock that's 10,000 shares or more. These are institutional investors, and the number of block trades gives you some idea of what the Wall Street pros are thinking. And you can find the number of block trades every day in the financial pages of the newspaper.
Decliners outpaced advancers by about 2 to 1. 1,250 down, 580 up, and 150 unchanged.
Technical factor number 3 now. Advances and declines, or as they are called, breadth. Now, using this highly powerful computer, I'm going to show you that if you add up all the advances on a given day on Wall Street, say today that IBM stock went up, and AT&T stock went up, and Exxon went up. Then, let's look at the declines. Bad day today for Texas Instruments, Digital Equipment, and Sears Roebuck. Now there is one last group of stocks whose prices did not change today, like Stretch. Now, if you look at all 3 stock groups, together you can see how many different companies were traded on the stock market today. Not how many different shares, but how many different company stocks. Some stocks, every day on Wall Street, are not traded at all. Nobody buys them, nobody sells them for the entire day. Now, going back to the computer, when advances outscore declines on a regular basis, you can, by looking at this graph, see if this day occurs over and over and over again, that the market is going to be on the rise. On the other hand, if there are more declines than advances, and this is a consistent pattern over a period of days or weeks, then it doesn't take a genius to know that the market is in retreat. What the Dow average tells you about a certain small group of stocks, breadth tells you about the market as a whole.
Now for something you'll never hear on the radio.
This is probably beyond the needs of the average radio listener, but you are going to want to know about technical factor number 4, the action of major stock groups. Now, we're talking here about automobiles and steel companies, technology issues, important groups of stocks. When they begin to move in any direction, that can be a signal of how the market is going to go generally. So say an important group like home building and housing stocks begins to diverge from the general market. Say they start going down. This could be a sign that soon related stocks are going to follow and go down too, like furniture companies and appliance companies, eventually even retail stores, because all these other companies rely for their business on the strength of the housing industry. If you don't build houses, you don't need new refrigerators. So if you are thinking like a technician and some important stock group starts to drop, even while the rest of the market is doing pretty well, this could be an early warning signal. Beware.
Technical factor number 5, new issues.
New stocks are issued all the time, sometimes because companies are going public, sometimes because old companies need to raise more money, And how willingly the investing public buys up these stocks is a very important market sign. Now, generally speaking, during a bull market, new issues are hot. People talk about, hey, did you hear about this new stock, whatever. They all want to buy one. They roll out in big numbers, and they get grabbed up quickly by investors because it seems during bull markets that the public's appetite for new issues is limitless. And of course, the more they buy, the companies are perfectly willing to sell them more. Eventually, however, it does get a little backed up. The public just can't take any more new issues. When the new issues market gets sluggish, prices for them won't go any higher. Even though the market is headed up generally, when this happens, watch out. This is a danger sign. It could mean that the market as a whole is about to run out of steam. So when you see prices for these new issues going down, with this oversupply, they easily could, it could carry over into the rest of the market. At the very least, this means that the public has lost its taste for speculation. Now, you can keep track of new issues in the financial pages of your newspaper. When you combine all of these technical factors, stock averages, volume, breadth, major stock groups, and new issues, this will help you look inside the stock market. You get a sense of the forces at work at its core, and that should provide you with valuable information to make your own investment decisions. But remember, they work best when you use them together over a period of time. Each by itself can be misleading.
Thanks for listening to All Stock Radio. Coming up next, Segment 6, Charts.
Breadth is the total number of shares of stock traded one day on one particular exchange. True or false? False. Breadth is the total number of different companies' stocks that were traded, not the total number of shares. Volume alone is not a very useful indicator. What else do you need to know? You need to know prices and recent trends in the market. You should always use them to help you evaluate volume. Which of the following is not a technical factor? A, volume. B, breadth. C, money supply. D, new issues. The answer is C, the money supply. This is a fundamental indicator. To find out more about it, go back to Segment 4.
Now we come to stock charts. This is yet another tool for market analysis. But there are people who go crazy over stock charts. They think that they can learn everything there is to know about a stock by charting its price. Well, before I show you how to do that, I first should tell you that we don't agree. We think you should use all the analytical tools we've talked about, fundamentals, technicals, and then stock charts. What stock charts can do for you is give you a quick, at-a-glance history of a stock's price, and you will see that that can reveal some important patterns. But first, I want to show you a list of stock prices, much like you'd find in your daily newspaper. These are prices from the New York Stock Exchange, and if you look over here, you'll recognize the familiar name of our favorite company, the Stretch Rubber Band Company, abbreviated here simply as Stretch. Now, as you can see, on either side of the stock's name, you will find a set of numbers, and some of you, anyway, have wondered what all these numbers mean. Let's take them one at a time. On the left side are the stock's high and low price during the previous 52 weeks. Moving to the other side of Stretch, we get the dividend, if there's been any declared recently, then the yield on the stock at today's price, and then here, number 10 is the current price-earnings ratio, and then the number of shares in hundreds that changed hands yesterday. Number 72 means here that yesterday 7,200 shares of Stretch were traded. Now, we come to the three numbers that you use to create the stock chart. These three columns here give you yesterday's high price, yesterday's low price, and the price that the stock closed at. These are the numbers for stretch rubber band yesterday, and the column right here next to me tells me the difference between yesterday's closing price and the day before's. You've had a nice day here, up 3/4. Now what we are going to do is change this information to this kind of information, and here is how. Each bar in this chart represents 1 day of trading of the stretch rubber band company. Let's just choose a bar, this nice long one here. Now the high point of the bar marks the day's high, the low point the day's low, and that little cross mark right here in the middle shows you where the stock closed. Now if you chart your stocks like this, day after day, you will end up with a graph very similar to ours. You can also chart the day's volume for a stock day by day. We've done that down at the bottom of the graph, so that at a glance on any day you can say, on this day volume was, and the stock price, however, did pretty well. It's a kind of X-ray of your stock's health. Now don't overrate what you can learn from one of these charts, but there are important lessons to be learned from the patterns that emerge. Most stock charts do look like this. They've got some highs, some lows, but the rises and the drops stay within certain limits. Often the stock will rise up to a certain point, but not higher. You don't see any booms here. Or it'll fall to a certain point, but not much lower. It's almost as if the stock's price was bounded by a ceiling and a floor. And the fact is that the prices of many stocks act like this. And the ceilings and floors are most apparent when you chart your stocks. Now there are clear reasons for those ceilings and floors. So let me start by demonstrating a floor. This is my price level. Let us say that the stock's price starts to fall to a certain point. And this happens again and again. At some point, the stock just stops falling. It just won't go any lower. The stock has hit a kind of floor, and that is because at this low price, it's gotten attractive to investors. They start buying it up, and that keeps the price from dropping any lower. Technicians call this floor a stock's support level. If the chart shows that this same support level has existed over a period of years, that's a good sign, because you can have some confidence that the stock probably won't drop in price below that level. So if the stock is currently at the floor or near the floor, you might consider buying it because the guess is it's not going to drop much lower. Now let's take a look at a ceiling. Say that the price is starting to rise. Now there is a point, and it happens over and over and over again, where it just won't go any higher. The stock owners think that this stock isn't worth more than this level, and they feel the price is going as high as it's going to go, so at this level they decide to bail out and sell, which keeps things from going any higher. Technicians call this ceiling a stock's resistance level. And if you find that the stock you want is hovering up there around that resistance level, then you better think twice about buying it, because at that point it could come down again, probably will, and down below it'll be a much better buy. Now, sometimes the stock market runs into a period of relative inactivity where stocks don't go up very much, they don't go down very much, they just kind of move along in a regular rhythm, kind of sideways. In fact, that's just what technicians call this, a sideways market. And they also call it a trader's market because only those who love to trade frequently and gather up small amounts of profit can make money in this kind of a market. But if you get impatient and you're thinking, well, come on now, I want to do some trading, like a bull market, like a bear market, this sideways market won't last forever. Our suggestion is, wait it out. Be patient. Wait till either you see bullish forces or bearish forces gather strength, and then make your decisions. Now, there is one more formation on the stock market charts that I think is worth mentioning, because every so often the market gets dramatic and shoots up, or takes a terribly big plunge, and sometimes it leaves a gap between days of trading. Look at this. There's a hole right here. This is called a breakaway gap. Sounds like a cowboy movie, breakaway gap. But actually, it's a very important sign. It's telling you something about your stock that you should not ignore. Breakaway gaps usually happen on days with high trading volume. Now, let's On the day that this gap occurred, look at this. See, this is the amount of volume on that day. These days are real kicks. They tend to push the stock in some strong direction. Watch what happened after this gap. The next day, the day after, the day after, the day after, prices drop dramatically. They start a momentum that can continue over time. If the push is up, like here's a gap going up, look what happens. Days, weeks, months, the stock keeps rising. If you get a breakaway gap when the stock is near its level of resistance or support, that could mean that the stock is about to break through the floor or break through the ceiling, and you may have to adjust your decisions accordingly. Basically, what all this means is that the price pattern of your stock over time could change after one of these breakaway gaps. And if you haven't changed your opinion about the stock, at least after one of these gaps, take a second look, because it may be time to make a move. All right, next up, we are going to talk about how to detect major market shifts.
What kind of a chart is this? It's a breakaway gap, a break in the stock price pattern that's caused by either a big push up or a big push down. If a stock is up near its ceiling or level of resistance, it's a good time to buy. True or false? False. Traditionally, the ceiling is the stock's highest price. You should think about buying when the price goes down and the stock hits its floor or level of support. Which three numbers from a stock's price listing do you use to make up a stock chart? A, yield, PE, closing price. B, dividend, PE, 52-week high price. C, high, low, closing prices. D, sales, yield, net change. The answer is C, the high, low, and closing prices. They're the ones you need to make a stock chart.
The stock market is a volatile place to be. It is always changing. But the most crucial moments are when the market hits a major turning point, whether it is swinging from bull down to bear or from bear up to bull. If a bull market is ending and stocks are about to plunge, you can lose a lot of money if you're not aware of it. Or if a bear market is ending and stocks are ready to come out of hibernation and zoom up, you can miss a great opportunity if you're not prepared. So one of your major jobs as an investor is to try to figure out when the market is going to make one of these shifts. It's never easy. And there are no foolproof ways to do it, but we do happen to have some guidelines.
First, the good news, bear to bull. There are 4 signals that tell you that a bull market is about to take off. Not all of them will be apparent all the time, but many will. Number 1, before things look up, the market has to have declined a lot and for a long time. Declines during a bear market can last anywhere from 6 months to 4 years, but you almost never get a bull market without a significant decline first. Number 2, the rate of decline should begin to slow. The market should be dull, volume low, day after day, sometimes for months. There's no stock market talk at the parties you go to, nothing about it in the newspapers. Nobody is buying stock, not even top quality stocks, which are selling cheap. Number 3, price-earnings ratios are very low. Investors aren't even interested in companies that are making money. And number 4, even when there's bad news, the market doesn't drop. It shows that stocks just refuse to fall any lower.
Add it all up, these are signs that the market may be about to turn because things are as bad as they're going to get. The only way to go is up. Bull markets usually start very slowly. Now, at first, there's nothing obvious. Volume starts to expand, but slowly. in the inevitable ups and downs from day to day, volume's higher on good days, but then it goes lower on bad days, up again and down again. And as the market improves, breadth increases, and then advances, beat declines on a regular basis, and now we're at the turning point. It's not very dramatic. You probably hardly noticed it, but it's easy to miss. It's time to make money in the market right now. If you buy now, at the turn, you'll be buying very low, and when the bull starts to rage, you'll be able to sell high.
Now the bad news, bull to bear.
Bear markets usually start with a crash. This is the dramatic side of the market. Bear markets start violently. Look at this turn here, with disastrous price drops, extraordinarily heavy volume. This is where people lose money big, so you must learn to recognize that turning point, and we've got 5 clues for you.
Number 1, before it falls, the market has had a long and substantial rise. Nobody wants to see the good times end. Investor confidence and enthusiasm are soaring. Everybody's asking each other for stock tips at parties. It's all over the newspapers. This is going up, that's going up. Nobody believes anything can go wrong. Right there, get worried. Number 2, new stock issues will be hitting the market at a record rate, but fewer and fewer people will be willing to buy them. So prices for new issues start to fall off. That's another danger signal. Number 3, when there is good economic news, the market doesn't respond. This is a bad sign. Even the economy does not push people to buy anymore. Number 4, market volume fades. Volume is down on good days. There's little buyer enthusiasm. On bad days, the volume goes up. People are now pulling out of the market. That is a strong signal that the bull market could be ending. And number 5, stock group divergence. The market as a whole is still heading up, but some important groups start to drop off. Now, this means that the market is getting more selective, and the decline in that one group might take other groups with it.
Taken together, if all 5 of these signs are present, well, that should add up to a pretty large flashing red light. And you've got some decisions to make. The crash hasn't come yet, but it's coming. Don't get fooled if everybody you know is still very confident. And don't feel bad if you sell your stocks and the market keeps going up for a month or so. So you got out a little early. At least you avoided a very big mistake. It's the guys who hang on who are going to lose the most in the end. So don't be greedy. And I'm going to tell you a little market saying. Bulls win, bears even win, but hogs get slaughtered.
Which is easier to miss, the beginning of a bear market or the beginning of a bull market? A bull market is easier to miss because it starts slowly and undramatically. If new issues are hitting the market at a record rate, but buyer enthusiasm is dying out, it could mean the beginning of A, a bull market, B, a trader's market, C, a bear market. The answer is C, a bear market. If volume is up on days when prices drop and down on days when prices rise, it probably means A, the bear is coming, B, there isn't much market activity, C, the bull is coming. The answer is A, the bear market is coming. When people are trading heavily and there is selling pressure, the market will decline.
Dividends. I love dividends. They're an important piece of the stock market puzzle. First, they generate income. Then they're a reason to buy or to sell a stock. And most important, they can affect the value of your stock.
What is a dividend?
Well, say these chips represent the profit of a company. Now, a dividend is simply a portion of the profit that's paid out to all the shareholders. The company's board of directors decides if the dividend is going to be very small or if it's going to be very big, and how often it will be paid. That decision is based on how well the company is doing and how much it needs to hold on to its money.
Where do I find out about dividends?
That's easy. You just open any newspaper, and in the stock listings, there's a column right alongside the name of the stock that shows the latest dividends paid for every stock. The Wall Street Journal, Barron's, practically every paper in the country tracks dividends.
How much are they?
They can be all amounts. New and growing companies may need to plow all their money right back into the business, and they may pay nothing. Others may pay a few cents a share. Companies that have been around a long time, however, can pay up to $4 to $5 a share. Dividends are usually paid every quarter, that's every 3 months. Some companies pay them every 6 months, some just once a year.
Is a large dividend good for the stock?
Not always. In fact, you could say that the more any company holds on to its profits, the better it is for the stock. Now, let me show you why. Let us say that this pile of yellow chips is all the equity in the Stretch Rubber Band Company. Now, you may remember equity from segment 3. It's everything that the company is worth. And again, let's say that these blue chips represent the profit that Stretch made this year, a very healthy profit. I mean, look at this, nice thick pile. If Stretch decided to hand out all of these profits to you guys, the shareholders, you, of course, would be absolutely delighted. You'd feel great. But look where it would leave the company. Nowhere. These chips could be paying for new factories, these for new machines, these for new employees, but no, I gave it all to the stockholders, so there's no money left back here for growth. That ultimately is bad for the company, and then ultimately bad for the stock. If Stretch decided instead to just give out some of its profits to the shareholders and keep the rest for itself, well, now you get a very different picture here. Now they can grow, and the equity of the company grows. Eventually, the value of the stock would grow too, and eventually, so would the price of the stock. That's why a large dividend is not necessarily good for the stock.
Who gets the dividend?
Well, this sounds easy, right? The person who owns the stock gets the dividend. But there is a problem: time. Stock is constantly changing hands, and it takes a certain amount of time and record keeping to write all those dividend checks. So on the day that it writes the check, how is the company supposed to know who's supposed to get the money? Well, to make it easier, companies establish a cutoff date that tells the investor the last day that he or she can buy the stock and still get the dividend. Now, let me show you how this works. Say that Stretch declares that it will pay a dividend on, this day here, the 30th of the month. Now, at the same time, it will also announce a shareholder of record date, which is usually just about 3 weeks earlier. We'll say here the 9th of the month. Now, what this means is that if you buy the stock so that you are listed as the owner of record on the 9th, you get the dividend. If you're listed after the 9th, then you're too late. You will get it the next time a dividend is paid. But for this one paid right here on the 30th, forget it, because it will be paid to the person who sold you the shares.
Is it worth buying shares at the very last minute just to get the dividend?
I know what you're thinking. You're thinking that if you buy a share of stock just before the cutoff date at like 4 seconds to midnight, then the next day you own it, you've put in 4 seconds of work, and you get the whole dividend for almost nothing. Sounds like a great idea, but it doesn't work. Let me show you why. I want to go back to my chips. Now remember that yellow is the equity of our company and blue is the profit. As we've already seen, if Stretch decided not to hand out its dividends, then it would increase the equity of the company. Stretch stands taller, it would be worth a lot more. So if it does hand out its dividend, then it stands to reason that the company is now worth less. Now, that should mean that each share of stock would also become less valuable, reduced by the exact amount that is paid out as the dividend. Well, that is exactly what happens. When a dividend payment is made, the price of the stock does drop by the exact amount paid. So if Stretch is selling for, say, $20, and then it issues a dividend of $2, Stretch stock will drop by $2, from $20 to $18 a share. What the stock market does is it declares a day when the stock price will drop by the dividend amount, and this day is called by the rather odd name ex-dividend date. It's usually 5 business days before the stockholder of record date. In Stretch's case, it would be up on the 2nd day of the month, just a week ahead of time. So you can see, it doesn't really make much sense at all to wait until the very last minute to buy stock for its dividend, because you'll get the money. But because the price has already dropped by the amount of the dividend, then really all you've done is you've broken even.
Does paying a dividend always lower the price of a stock?
The price will always be adjusted down on the ex-dividend date to take into account the company's reduced equity. Remember that. But the announcement of the dividend, which usually comes weeks before the stockholder of record date, that announcement can push up the stock's price. And that is especially true if it's a new dividend or a much bigger dividend than anyone expected. That's a sign the company's doing well. And in that case, people will start buying the stock and it'll go up.
Are dividends always in cash?
No. Sometimes instead of paying you in cash, they're going to pay you in stock. The company may want to hold on to its cash, but still do a little something for you, the shareholders, to make you feel good. So they issue a stock dividend. So they may give the shareholders 1 share of stock for every 5 or 10, or 2 shares of stock for every 5 or 10, whatever the combination. Just as with cash dividends, the value of the stock will fall by the value of the stock dividend paid. What they're doing, see, is they're splitting the pie, the same pie, into more pieces by issuing more stock. So each share is going to be worth a little less.
What is dividend reinvestment?
I'm going to only answer one more of these. This is the last one. Lots of companies do offer dividend reinvestment plans. And you can tell the company to take your cash dividends and turn them into more shares of stock, which frankly is a good idea if you're getting dividend checks for very small amounts, checks for like $12, $20, $30 every 3 months. You never know exactly what to do with a check like that. Well, this way, you end up with a lot more stock. And most of the time, this is interesting, most of the time you don't have to pay a brokerage commission. So write to the shareholder or the investor relations department at the company's headquarters for more information.
If you buy a stock after the shareholder of record date, you will A, never get a dividend, B, miss the current dividend but get the next one, C, only get half the dividend. The answer is B. You'll miss the current dividend, but you'll receive the next one. On the ex-dividend date, the value of your stock falls by the amount of the dividend issued. True or false? True. When a company issues a dividend, the company's equity is reduced by the amount of the dividend issued. A dividend reinvestment plan. A, turns your cash dividend into additional stock in the company. B, issues a stock dividend instead of a cash dividend. C, automatically deposits your dividend in the bank. The correct answer is A.
Up until now, we have only talked about common stocks. Now, there is a reason for that. We think that investing in common stock gives you the best shot at protecting your money and watching it grow over time. But there are plenty of other investment opportunities out there. Some are safe, some not so safe, but nevertheless, we think you should know about them. Mutual funds are a relatively safe and easy way for small investors to get into the market. Because instead of worrying about buying stocks, selling stocks on your own, you buy into a fund that is run by professionals. They do all the work, they make all the decisions. And what makes this fund mutual is that you're in it together with lots of other small investors. Your money is pooled for greater buying power. And that way the fund can buy lots of different stocks and spreads the risk among the group. Now, generally, you buy into a mutual fund for as little as $1,000, and after that you can add on in smaller amounts. There are 2 questions that you could ask before you buy any mutual fund. One is, what type of stock does it buy? And the other is it a load or a no-load fund? Well, let's take this question first. To meet your investment goals, you need to know what type of stock the fund is going to buy. They don't all buy the same stocks. Some buy into conservative, steady companies for slow growth. What they're trying to give you is steady income, while others concentrate on rapid growth. These funds are looking for stocks where the price will shoot up quickly. Now, you can choose either one, but remember, these are more risky. You should also find out if a mutual fund charges a commission. What are called no-load funds don't charge, whereas load funds do. These guys charge you a load every time you invest, and usually it's between 3 and 8% of what you put in. Now, in addition to common stock, companies often issue another kind of stock. It is called preferred stock. Now, why preferred? Well, it is stock that comes with certain advantages over these common shareholders. Would you mind, please? Good. First, preferred stock comes with a guaranteed fixed dividend. You know what you're going to get when you buy the stock, no matter what the stock price, and usually no matter how the company's doing. Unless things are really horrible, you get your dividend. Even if the company doesn't pay a dividend on common stock, it will still pay a dividend to its preferred shareholders. Now, before you buy any preferred stock, you ought to find out if it is cumulative or non-cumulative. If you have cumulative stock and the company is forced for some reason to skip a dividend, those back payments will accumulate, but the company will make good at some point in the future and give you all the dividend payments it missed if your stock is cumulative. If it's non-cumulative, you're out of luck. Now, on to something completely different. So far, all we have talked about are stock investments. And as we explained much earlier, stock is equity. What you buy with some stock is a small portion of ownership in a company. But there is another kind of investment, totally different, debt. Not your debt, somebody else's debt. You lend money to a company or to a government, and they give you a piece of paper promising to pay you back with interest. And these are called bonds. Now, there are many kinds of bonds, but basically they all work the same way. You give your money to one of these corporations or Uncle Sam or whomever for a specific length of time, and through that whole period, they pay you interest. When the time is up, which is called bond maturity, they give you back the money. Now, there are two things to look for in a bond. Number one, ask yourself, is it safe? And then say, what is the interest rate? Bonds are traded constantly, just like stocks. The prices don't fluctuate as much as stocks, but they still go up and down. What affects the price the most is interest rates. Now, let me give you a little rule of thumb. If interest rates go up, bond prices drop. If interest rates drop, bond prices rise. Okay? As for safety, each new bond is issued a safety rating by Standard & Poor's and Moody's, and the safest rate for a bond is AAA. Federal government bonds are extremely safe because, think about it, Uncle Sam, to pay you back, can either raise taxes or, if necessary, print money. So you should always ask about the safety rating of a bond before buying one. And now, finally, let us take a look at the world of exotic, specialized, and let me emphasize, dangerous investments, which are just over there. You are going to hear about options and futures and index futures. These are all for very experienced professional investors only. They are not for inexperienced, financially unsophisticated people. And with that understood, and paying clear attention to the flashing red light over my shoulder, I will now very briefly explain options. This is an extremely sophisticated guessing game. You never really own anything. What you do is you buy the right or the option to buy or sell a stock at some time in the future. But you agree upon a price today. Now, if you decide that you just can't stay away from options, at least be aware of what you're getting into, and don't go into options on your own. Get good professional advice. This is hardball, and you could get hurt. But whatever investment road you decide on, We do wish you a lot of luck.
Name two types of preferred stock. The first is cumulative, which means if a company is forced to skip a dividend, those back payments can accumulate. The second type is non-cumulative. With this kind of preferred stock, if the company misses a dividend payment, you lose. A mutual fund that charges a sales commission is called A, no load, B, discount, C, full service, D, load. The correct answer is D, a load fund. Which of the following is a bond that can't be bought? A, municipal, B, hospital, C, James, D, corporate. The correct answer is C. James Bond cannot be bought at any price.
Okay, we're just about at the end of the course. If you've made it this far, you now have a pretty good beginning knowledge of the stock market, but I bet you've also got a lot of questions. And it just so happens that some advanced copies of this tape leaked out, and the letters, somehow or other, have started pouring in, so we'd like to read you a few of those.
Dear Robert, after I buy stocks, do they mail the certificates to me? Signed, Puzzled.
Puzzled, it depends on what kind of account you have with your broker. When you open your account, you can choose to have the stock sent to your home or to your office, or you can have the brokerage firm keep it. And if you're the cautious type, have it sent to your home. Then, of course, you got to figure out where to keep it safe. And if you decide to sell suddenly, you're going to have to get that stock to your broker quickly. So it's probably more convenient to keep it with the broker.
Dear Bob, is there any way I can get a corporate report for free? Signed, Frugal.
Frugal, almost all corporate reports are free. If you own a company's stock, you get the report automatically as soon as it's published, for free. If you're a prospective buyer, you just write to the company and ask for one, and they'll send it to you, for free. The Securities Exchange Commission in Washington, D.C. makes files available to the public, and that's to you, and so will the stock exchange.
Dear Robert, what's a margin account? Signed, Marginal.
Well, a margin account is simply a credit account with your broker. It gives you the right to borrow money from your broker to buy stock. Nothing else, just stock. The margin is the percentage of the stock's price you've got to put up in cash. It's your down payment. Margin requirements are set by the government. In recent years, they've been 50%, so that means if you want to buy stock on margin, you put up half the cost and the broker lends you the other half. Now, obviously, you can buy more stock this way, but you also, remember this, you also have to pay the broker interest on the loan, so it gets expensive.
Dear Robert, what is selling short? Signed, Short but Proud.
Well, Proud, selling short is a tricky technique for sophisticated investors. It's a strange transaction because when you sell short, you only make money when the price of your stock goes down. That's right, down. Now, let me take you through this. What you do first is you call your broker. This guy over here is my broker. And I tell him that I want to sell stock short, and it can be any amount, it can be any stock, but of course we're going to call it 100 shares of the Stretch Rubber Band Company. Now, what is really strange about this selling short is that it seems to mean that I'm going to sell something that I own, but actually I'm going to sell stock that I don't actually own. What my broker does is he looks for one of his other clients to lend me the 100 shares of Stretch. So look around, see who, she, I assume, is willing to lend me 100 shares of Stretch Rubber, so she gives the shares to him. Now, when he gets the stock, he doesn't give it to me. Instead, go ahead and sell it on the exchange, exactly like any other stock transaction, and let us say that he gets, $20, $20 a share, and that is $2,000 that is credited to my account. So Now I sit here and I wait, I watch the market. What I am hoping for, you remember, is that stretch rubber band will fall in price. And also remember that I still owe something to her. She's owed 100 shares of stock. Now let's say I get real lucky and after a couple of weeks, the price of stretch falls to $10 a share, half what it used to be. At that point, gleefully, I call up my broker and I tell him now is the time to buy 100 shares of stretch, now costing only $10 a share, or $1,000. So, I got $2,000 here, remember. Broker, go ahead and buy me 100 shares of stretch rubber. Oh, I got to give you the money, all right. But I only have to give you 1,000 now. Go ahead and buy it. Okay. He now has 100 shares of stretch rubber. This is called covering. He's going to return the shares to my original lender. She is now happy. She's got her shares back. This is selling short. Now watch what happened. I paid $1,000 for those shares, and there is now $1,000 left for me. Clear profit. But there are several buts that you must pay very close attention to when you sell short, because things do not always go quite as smoothly as you just observed. This is not a transaction to be taken lightly. Selling short is different from a normal stock transaction, and there are hidden dangers. Consider, suppose the transaction that I just showed you just a minute ago had gone very differently. I called up the broker, I sold the stock short, just like before he borrowed it, and sold it for 20 bucks a share. I still got my $2,000, but this time, as I sat and as I watched the market, the price of stretch, instead of going down, went up. Say it went up to $30. I still have to replace the stock that I borrowed from her. Now, 100 shares of stretch rubber band now costs, at 30 bucks a share, $3,000. I only have $2,000. In order to give her back her stock, I'm going to have to take the $2,000, reach into my pocket, and take out my own $1,000. I've just lost $1,000. Let me emphasize that selling short is not for everyone. If the stock had gone higher, I could have lost $2,000, $3,000, $4,000. Don't try it until you've had much more experience.
Dear Robert, what's an odd lot? Signed, Feeling Peculiar.
Well, peculiar. Stocks usually trade in units called round lots, which is usually 100 shares at a time. Now, an odd lot, aside from being a collection of strange people, is the purchase or sale of anything less than 100 shares of stock. The Wall Street Journal and other papers publish odd lot statistics every day.
Dear Robert, what is par value? Is it something like golf? Signed, Bertie.
No, par value has nothing to do with golf. In fact, it doesn't have much to do with anything except technical accounting rules. When stock is first issued, the company is required legally to establish a par value for the stock. It is the face value of the stock. But essentially, it's a meaningless number. It bears no relation to the thing you care about, the market price of the stock, what it sells for. So, frankly, ignore par value. In fact, forget you even asked.
Dear Robert, what's a proxy? And what's a proxy statement? Signed, Baffled.
Well, a proxy is a ballot. It allows you to vote on company issues. The company sends you a proxy statement, they call it, along with the actual proxies. The statement is the company's explanation of the issue you're supposed to vote on. Its recommendation on how you should vote is also included. Then you fill out the proxy and you sign it, and you're giving your authorization to vote your shares a certain way. And by the way, you don't have to vote their way.
Dear Robert, can I buy stock in foreign companies? Signed, Over There.
Well, as a matter of fact, over there, you can. But to do it, you must have a broker that either has branches in other countries or works closely with foreign brokers. And it does cost a little more to buy foreign stock. You will be paying first for the commission of the broker on the foreign exchange, over there, and you will be paying for your own broker's commission. And then the stock price will also be affected by changes in the currency rates. Say, for example, you are buying on the Tokyo exchange. You're going to have to transfer your dollars into yen, because they don't take dollars over there. That's to buy the stock. Then when you sell the stock, you got to take the yen and turn it back into dollars. If the exchange rate goes against you, well, it can eat into your profit. But you can do it. And also, I want to thank you all so much for these cards and letters and for the holiday loaf from Des Moines. It was very nice. Yes, I know, Chet, but this is a special situation. I think that the secondary issues are starting to take off on the upside.
Right. But with a book value of more than $17 a share and a debt of only 20% of equity, Stretch has good downside protection. Now, the initial offering was a blowout, but there's been a lot of tailgating among the dealers, and the stock hasn't been affected by the correction.
But, Chet, I just don't think it's overbought. Now, a lot of speculators have been stopped out of a short position, and I'm convinced that we're ready for the second up leg on this market. And, Chet, I really believe that it isn't a cyclical market. It's secular, Chet. This stock is in a rising technical pattern, and it is attractive for commitment, I think.
Well, you could be right. But I think the market's a bit shaky near term. There's substantial upside potential for the intermediate term. The real key will be what triggers the next upside move.
Well, what do you think that will be?
Well, equities right now turn on interest rates. So the market over the near term will be affected by the success or failure of the Treasury's new offerings. After that, we should see this period of consolidation end.
Well, then what do I do?
I'd upgrade some of your holds to buy holds, some buys to sells, and make sure all your targets make sense.
Oh.